So welcome to the second video of this trading bot series. Today I'm going to be focusing on the process of building a trading bot. So we're going to be looking into the steps of what we have to do to achieve the end goal of having a live trading bot. So as you know, this is the second episode of the trading bot series in which I cover my progress in building a trading bot in Python. In the first episode we covered how a trading bot works, so we'll be using a bit of that in this episode as well. So if you haven't already watched it, make sure to check it out. There'll be links in the description, in the playlist, and on the channel. I'm hoping to post once a week, so if you've caught up on all the episodes so far, make sure to subscribe and turn on notifications so that you know when the next one's out. So let's get started with this episode. So here we've got the 11 steps in building a trading bot in Python. To start off with, we're going to look at choosing a platform and framework. So what we're talking about here is what we're going to be running our algorithm off. What is the framework for our bot? This is a topic we're going to be covering in the next episode of the series. We're going to be comparing different frameworks and platforms available to us, but here I'm just going to discuss how to actually choose one. So the first thing that we're going to be looking at, and the main thing, is suitability. So this pretty much encompasses all about choosing a platform and framework. And so the first thing that we're going to be looking at is your language. So this is your programming language that you want to be developing the algorithm in. And so the language that we're going to be using in this series is, of course, Python. This is a great beginner language. It's the language of new data science. Before, it could be seen as MATLAB, but it's starting to make the transition over to Python. And so don't worry if you don't know programming at all at the moment. It's something that you can pick up quite easily. In fact, I'm going to do a video soon on the best places to start coding, best resources to start coding. And so make sure you stay tuned for that one. And don't worry, we're not going to be going into any back-end coding, any complex coding. It's going to be quite high-level, logical data analysis and data manipulation coding with Python. And so the next thing we're going to be looking at is cost. And so as a student especially, you don't want to be shelling out £20 a month for a service, a piece of software that you're not going to be using for actual trading. So what we're going to be doing is what's called paper trading, which is where we're basically constructing a virtual portfolio with virtual stocks as if we had, I don't know, £10,000, which we don't, unfortunately. Maybe soon. We'll see how it goes. And so cost is quite a big consideration as we're not getting any actual returns which would offset this. When you possibly move to trading with actual capital, then this is something which can change quite a bit depending on how much capital you're investing and what your expected returns are, but we want to be keeping cost as low as possible. And this will be explained in the next episode where we look at the different platforms. The next option, this is specifically if you are trading with actual capital, is brokerage options. And so the main platforms and frameworks could be integrated with the different brokerages. So this is when they're sort of partnered up. It's quite easy to integrate into your algorithm to be able to use a certain broker. And so the other option is where there's no integration whatsoever, and so you are out there to choose your own broker, but then you also have to integrate it in yourself. So there's flexibility with, you can choose whatever broker you'd like, but then there'd have to be the measures in place, for example, the API that the broker will provide to be able to communicate with the broker. And so the next thing that we need to look at is deployment, how this trading bot is going to be deployed. And so there are two main ways of doing this. So you can deploy it locally on your system, and you can deploy it in the cloud on the platform's systems. And so we'll look into the advantages and disadvantages of this in the next episode. Last thing that we need to look at is what data is available. And so there'll be two types of data which will be available, and it'll be great if they're the same for both. And this is historical and live data. And so historical data is a lot easier to access than live data for the obvious reasons. And different platforms may have different data included with their service, and this is something that we'll look at in the next episode. And this is quite a key consideration, as we don't want to be going too deep and spending most of our time in trying to obtain the data. We want to be working on the actual algorithm itself. So let's move into the next step, which is understanding our platform. Now, a lot of the platforms can differ in slight ways. The underlying of it has the same principle, the same process, but I would definitely recommend checking out the tutorials on boot camps with regards to each individual platform. And so the next thing that we need to know is about our data again. So what historical data is available and what up-to-date live data is available and how those integrate into our bot. So let's move on to the next step, which is again talking about data, and this is the data science process. So this first part, obtaining the data, that's going to be done for us in the platform that we're going to use, which I'll discuss in the next video. The wrangling part is also going to be included. And so what do we mean by data wrangling? So this is when we clean and format the data. So cleaning the data, that might be sorting out what we do with when there's missing values, which will be something that we discuss in a later episode. And then another thing is data bias. So quite a well-known bias in the quant world is survivorship bias. So what do we mean by survivorship bias? This is when we overlook securities and stocks which no longer exist. This leaves us susceptible to generating false returns in our backtests. We don't know whether our strategy would have invested in Lehman Brothers back in 2007. We don't know whether we would have lost a lot of money back then, which could lead us to making false conclusions about our strategy. This could happen in the future, and we wouldn't have been able to identify these problems if we didn't have the data of the companies that failed. So this is a key consideration to take into account, and that's why it might be better to use data which is provided for us by the platform. And so the next part of the data science process is understanding the data. So we're going to be looking at two things here, and this is the type of data. So this is what it's telling us. Is this price? Is this fundamental data of the underlying company, like balance sheets or income statements? Or is this potentially estimates, analyst estimates on the earnings of different firms? And then we're going to look at the resolution of the data. So this could be whether it is daily data or minutely data. And then the next part that we're going to be doing is exploring the data. And so this is part of the research process as well, which we're going to go into next. So exploring the data, what does this mean? So this is where we really delve in deep to find out what the data is actually telling us. And the whole point of this is we're trying to discover something called alpha. Now, I'm going to be talking about this a lot in the series. And so to give a brief description of what it is your advantage over everyone else. And so when I mean advantage, I mean it's knowing whether a stock will trend up or whether a stock will trend down. And if we know this before everyone else, then we can buy or sell at each point to maximize our returns. So alpha is the key part of this. This is where we get our returns. This is where we get our advantage, because there's no point in investing our money in an active strategy which underperforms a benchmark, because then we could just put our money in an index tracker. So this alpha is what we've got over the rest of the market. And so after exploring the data, we might find alpha signals. So this is when there's correlation between the data of the stocks and then its returns afterwards. So this signal would, for example, say X variable has hit Y limit, and then we might find in the past that this has triggered an increase in the stock price. And so we're going to analyze these signals, find out how accurate they are, how reliable they are. We don't want a signal which only predicts correctly 30% of the time. So this is the part of analyzing the alpha signals. And so this leads nicely into backtesting and performance analysis. So this is where we combine our alpha signals, our factors, which I will go into in a future episode, and we look at the historical strategy performance. So we look as if we invested X amount of pounds back in, 2002, and we see how that performed up until today, 2020. And so what are we looking for? We're looking for good returns for the risk that we take. So once we've run that backtest, we can look at loads of different metrics and trends that our strategy produces. So we need to look at turnover. There could be the possibility that our strategy requires high turnover, which could lead to high cost, which may be something that we want to take into consideration. the volume of stocks that we're trading, and the proportion of the portfolio which is invested in different stocks. So this is something that we need to take into consideration on whether the strategy is actually viable. Then we look at the returns compared with a benchmark. So this is a benchmark that we think is suitable for the universe that we're going to be trading. What we don't want to happen is to employing this active strategy and end up just being worse off than if we just invested our money in an index tracker, for example. And then we look at our risk. So what is risk? Risk, in essence, is the standard deviation of the stock returns. So in a nutshell, would you rather invest in a stock which does this, or in a stock which does this? They both end up at the same point, but as we can see, B has more deviation from this trend and therefore more risk. And so linking into that, we have drawdowns. So drawdowns are periods of negative returns. So for example, this period here between these 2 points is a drawdown. And then trade frequencies, so this will be looking at whether we trade 5 times a day, 5 times a week, or maybe once or twice a month, and whether our alpha signals are giving enough information for us to maximize our returns. And then another thing that we need to look at is performance attribution. How do we know if our performance is coming from our alpha? We don't. We might just be getting lucky with our stock selection at that point, or we might be getting lucky with what industry we're investing in. And with quantitative investing, we're not making any bets on whether the market's going up, what industry is going up. We're making bets on our alpha signals. And so we want the majority of this performance to be coming from this alpha, because this is proving that we've actually found an advantage over everyone else. And so with regards to this strategy trends and reducing cost, we move on to the next part, which is optimizing parameters and applying constraints. So the first part of this is finding optimal parameters to maximize our return. We may find that increasing a certain parameter or decreasing it may lead to us generating more frequent alpha signals or more accurate alpha signals, which will allow us to maximize our returns. And so the next thing that we do is we constrain to maximize our net return per unit risk. This is also known as the information ratio, which is something that we'll go into plotting and calculating in the future. But to give you an example, we might have strategy performance which looks like this and that, and might end up here. And so when we look over the whole term, we see, okay, looks like our capital's increased. Great. But if we look at the risk, the deviation from this part here, if we look at this deviation, this is big risk that we're taking on. You never know, we might end up at the point where we're down here and we're pretty much broken even. And so it might be better to have a strategy which slowly rises and generates smaller returns but taking on less risk. And so this is what the information ratio is basically saying. And so this is where we can constrain our different position constraints. So this may be saying we can't have more than 20% of our portfolio in one stock or more than 40% in a certain industry to reduce these shocks that we get, these drawdowns. And we could also have positive shocks, but that is still risk. So we want to be minimizing risk, but still getting good enough returns. Another point is reducing our costs. If we're trading too much, we may be charged a commission or a fee each time we trade. So if we're trading 5 times an hour to get 0.1% extra return over trading 5 times a day, it might be better to constrain ourselves to trading 5 times a day to reduce our costs. So this whole point is maximizing our net return per unit risk, which we will do in a future episode once we've developed our strategy. So we've got our research process, the researching the data, exploring the data, finding our alpha signals, then backtesting these strategies, combining different factors, and then optimizing and constraining our strategy. So we're going to repeat this research process over and over until we reach the best version of our strategy which suits our risk profiles and our goals. And this isn't just something that you do once, this is something that you can do as an ongoing process. You may find new insights in different data, or you may find changing one parameter or constraining one different constraint could increase your return or could reduce your risk, which is the two things that you want to be doing. And so once we've got our strategy, we want to be putting it into live production. So now we're going to be looking at integrating live data. So the three things that we need to do here regarding live data is make sure that they're reliable, accurate, and up to date. We don't want to be trading on data which may have missing data in it. And the other thing that we want to be doing is trading on data which is wrong. And we want to make sure that our data is up to date so that we've got the best advantage over everyone else. And so as you can see, this allows us to maximize our alpha capture so that we are straight into making the right decisions on whether a stock is going to go up or down, and that we have confidence in our trades, confidence in our strategy, confidence in our portfolio, making sure that we know that the data that we've got is going to produce the correct results. And so that leads us into our next point about actually placing the trades. We want to choose a broker. So this is something particularly if you're going to deploy a trading bot with actual capital. So there are two parts of this: compatibility and suitability. So compatibility may be residency. There could be some brokers which are for US residents only or for UK residents only, etc. So you get the idea. If you're neither of those, then you might not be able to use a broker. And so this ties into the legal status here as well. There may also be minimum account requirements. So this could be a minimum deposit of, let's say, 10,000 USD. And so if you're unable to put that capital up front, then you may be unable to open an account. There may also be minimum trading volumes per month. So if you don't trade X amount each month, then your account will get closed, etc. So that is all about compatibility. So that's whether you are able to actually have the account in the first place. The next part is suitability. These two here are all costs of trading. And if you're an infrequent trader, then it may not matter that much what these costs are. But if you're a very frequent trader, then you may be looking to lower commission, lower fees, so that you're not getting hit each time that you trade. And then the last part, suitability, is what platforms you can use. So this may be, do they have an API to allow you to trade with? Do they have the ability to trade stocks online? In the past, it was done all on the phone or by mail or in person. Obviously, this doesn't apply this much nowadays, but another part could be, are you able to trade on an app if you want to make a last-minute trade? These last two here aren't as important with regards to a trading bot, as we're going to be doing this systematically through an API. And so once we've got our strategy, we've researched the strategy, we're confident in it, we're confident in the data that we're giving it, and we've chosen our broker, we know how we're going to do our trades, then we're then going to do the final step of deploying the actual server. So with deploying the server, we have these two options, whether to do it on the cloud or locally, which will be discussed in the next episode. How we're going to communicate with the broker, so this is going to be over API. But to give you an example of when you might not use an API is when you use your trading bot to tell you what trades to do. So you may rebalance your portfolio every week, for example, and therefore you don't need to make these quick trades. You just need to do it, let's say, every Wednesday at midday. Your bot tells you to do these trades, and then you can do these trades on your app, for example. But in this series, we're going to be using an API because we're going to be looking to do more frequent trades than that. And then the last point is putting in fail-safes. So what happens if you're running locally and your computer shuts down, things like that. So this could be, it can notify you, etc. And so that is how you deploy your server. But this isn't a one-stop thing where you deploy your server, you've done your strategy, you just leave it to run in the background. You can do that, but if you want to improve over time, then it's an ongoing process. You monitor and improve your strategy. So you've still got this ongoing research in the background. You don't need to be doing as much, but it's good to stay on top of your performance and seeing where you may be falling short. And this all helps to improve your strategy and therefore maximize your returns. So I hope you've enjoyed this video regarding the process of how to build the trading bot. We're going to be going through all of these steps in the next couple of episodes, so make sure you subscribe and turn on notifications for that. If you enjoyed the video, please drop a like and make sure to check out other videos that I may have on the channel. And I look forward to seeing you in the next video.